You see someone else doing well or something works for someone else, and then you're thinking, okay, I got to do that same thing.
So you guys know each other's businesses very
Oh,
well.
yeah.
That's Babs Ogundeyi, Laurin, Hainy, and Tosin Eniolorunda, the CEOs of three of Nigeria's largest digital banks, Kuda, FairMoney, and Moniepoint.
I think given enough time, we will all probably end up in similar places. Banks will be like fintech, fintechs will be like banks, fintechs will be like each other.
I knew I had to also build trust. I know it was certainly very difficult. We had to do a lot of work convincing.
So very quickly we realized, okay, this is actually hard. And then you fail again, and then you do a bit better. And there's a reason why learn.
This episode of The Flip was recorded live at the FinTech in Africa Summit in New York, where some of the biggest growth stage fintechs from across the continent were brought together with global investors and strategic partners. Be sure to check out FT Partners' latest FinTech in Africa research report, which we've linked to in the show notes. Before we start, we have one small favor to ask. If you enjoy the show and want to support the content that we create, please hit that subscribe button. It only takes a second, but it will mean a lot to us if you do.
Tosin, so I want to start with you. Moniepoint has most recently become an MFB, but you started as a distribution first. You built out the physical infrastructure.
Yeah.
It's interesting because we might use the term neobank, but you're not necessarily a neobank, I suppose, if you have physical infrastructure.
Yeah.
But I want to start with your decision to build physical infrastructure as a way to extend financial services at the last mile. And then we're going to talk about the different approaches that they've taken to doing so. But why physical infrastructure and why build the company in the way that you did to the point that you have today?
I mean, it's simply just the means to an end, which is distribution to the end customer. And it seems to us that the best way to reach out to these customers is being physical. And we simply took that approach. Of course, more recently, we've also built out digital customer acquisition and also seeing good results also in that. And also because the product we started with, by its very nature, which is agency banking, is kind of physical. You deal with point-of-sale devices. I mean, in Nigeria, I don't think logistics or shipping devices is, very well developed. Or like if you're in the UK and you could get a point-of-sale device mailed into your office or your home. So it's like we really didn't even have a choice than to build a distribution system to get the point-of-sale devices to the agents. And of course, that's how we built the competence and scaled that.
Yeah. So then, Laurin, for you, your approach to providing digital financial services was through a credit perspective first, right? And I think we know the story about very low access to credit really across the continent, especially in Nigeria. So you chose to start there, right? I think you were doing lending as a point of entry for a number of years before you became a MFB or acquired your license. So can you talk about that decision to enter the market through lending first and then building out the sort of neobanking infrastructure once you had your license?
Sure. So, I don't think, today we are all not that different anymore, right? If you start in the end, I think we started as a lender and then started to take deposits a few years ago. And then we bought in sort of like today it's called FairMoney business, used to be called Payforce, which is also a merchant acquirer POS business. And then currently building out the offline infrastructure. So in the end, I think the conversion is everyone ends up in the end in the same point if they execute well.
Yeah.
But we chose loans or lending as first point, which I still think is, for us it's worked really well. For two reasons. First, honestly, the most pragmatic reason was we needed to generate revenue from early on. We didn't have any VC money 6 years ago. That wasn't a big thing. It was a thing then a few years later, but we just didn't have anything else. So we literally looked at which product generates meaningful amounts of revenue and helps pay the bills. And that was lending. And then later, as we did this for a few years, we started to take deposits to decrease the cost of funding and so on and so forth. But that was really the original idea, and also that it converged with what customers needed most, right? So that was positive. And now, as I mentioned, first loans and deposit taking, now merchant acquiring, business, B2B business, POS business. So yeah, in the end, we are not that far away.
Yeah. And Babs, for you, from a Kuda perspective, you're maybe the most traditional pure play neobank, digital customer acquisition, digital financial services. Can you talk a little bit about why that's the approach you took? I know that there was a little bit of like experimental lending at the beginning, but that's certainly not the focus of your business relative to FairMoney, for example. So why that approach?
Yeah, I mean, I think obviously, clearly, we have two founders here that have taken different approaches. So definitely there are different ways to skin a cat. For me, I decided on this path for different reasons. I thought, maybe rightly or wrongly, but I thought it would be much harder to get people to give you money rather than you giving out money. We did think about the lending as a starting point. My decision was actually altered by, I spoke to an investor. I can't remember who exactly it was, but I spoke to an investor when we kind of experimented with lending. And I think we had like 1,000 potential customers at the time. And I was told, well, that's not traction. And for me, you kind of needed the money to show traction with lending. So I decided very early on to go the other way to ensure that we can get the kind of traction required that would attract funding.
Yeah. What is better than transacting in 4 currencies? More currencies, more markets, and a single settlement in your preferred currency. If you want to expand to multiple African markets and do it fast, Ownafrique is the treasury partner for your journey. Simplifying processes is built into their DNA, and by connecting to their vast network, you reduce the stress of dealing with multiple balances and partners. Just one connection gives you multiple currency collections and disbursements across markets, competitive FX rates, float continuity, and customized FX solutions for real-time payments. Every solution built is focused on your business growth. For your tailored treasury and FX solutions, go to ownafrique.com. That's ONAFRIQ.com.
I think the takeaway for me, for all three of you, is you saw that there is a gap, and this is, I suppose, fairly obvious, that the banks in particular aren't able to, either reach the last mile, aren't provisioning credit, just aren't servicing customers in a user-friendly way, right? And so all of you decided to go for that. And I'm curious now, as you've scaled, especially, how you think about this role that you play relative to the banks, right? We have this idea that the banks aren't innovative, they can't reach the last mile, et cetera, et cetera. I think there's, capital requirements with central bank that makes it hard for them to lend. There's just sort of legacy infrastructure and institutions. Maybe Tosin, I'll start with you because, you came from InterSwitch, you dealt with the banks a lot, you had built, banking infrastructure. Yeah. So how do you think about that? Like where you stand, Moniepoint stands today as it relates to the financial services landscape as a whole in Nigeria?
I think given enough time, we will all probably end up in similar places. Banks will be like fintechs, fintechs will be like banks, fintechs will be like each other, because as you're seeking growth, you can grow deeper, you can grow wider, and your wider might be offering more products, which makes you start doing what every other person is doing. Your wider can also become going to more geographies. I think eventually everybody will be like, we'll be like ourselves. But talking about banks, I think banks fundamentally, I was listening to Babs, and he's right about it. The problem is the way they think. Unless you change banking leadership to become like a tech-first organization that is run with products, science decision-making, and engineering at the forefront, I think they will always be classic bankers. And so the way I look at it is that as long as the leadership of both different factions, banks and fintechs remain the same, fintechs that are going product and engineering and customer and data-driven decision-making will possibly move ahead. There is one elephant in the room, it's the license. I think fintechs are a little bit afraid to get banking licenses until you get to a certain level, mostly because of the way classic banks are valued on a net book basis. And a lot of us are valued on revenue multiples, and you are afraid of valuation compression or that. But if you want to kind of really, really be honest with yourself, eventually down the line, if you want to continue growing and handle as much customers as possible with the trust level that you expect them to have for you, I think you need to get a banking license, which will make you become one. And if you take a look at Neobank, I think Neobank now has a banking license.
Always had one.
Sorry?
They always had one.
They always had one. Exactly. I hear Revolut is really pushing hard to get a banking license. So eventually, fintech will now be about how you think, not just a license now.
Yeah.
How do you run the business? And is your finance being really truly powered by technology and products? And then eventually I proceed. It's not like I proceed. I already do a bit of what FairMoney classically does. Kuda is doing a bit of what Moniepoint is doing, a bit of what FairMoney is doing. We just have our different strongholds, which I think we'll all hold on to and begin just to develop other aspects of the businesses. That's, I think, how it's a look out.
Because from a FairMoney perspective, I think a lot of people talk about the banks have so much capital, so to solve like an SME lending issue, we want the banks ultimately to deploy that capital, but it feels quite far-fetched that they're going to do like SME lending or consumer lending, right? Certainly as well as either some of the vertical players or as well as FairMoney. So I'm wondering from your perspective, like if everything is going to converge or if you're like, I don't feel that concerned about the banks doing lending better than I'm doing.
I think we should consult a bit of history here to understand the problem. Because, so if I talk to my like grandparents about what we do, or my older uncles, right? I don't know if you have the same experience, but they would still remember that when they were sort of 25, 30, or I'm 33 now, my age, at that time, the GT banks and the Axis banks and now Zenith banks, they actually started to innovate, and at that time the innovation
New
was
generation bank.
Yeah, well,
That's what you should call them.
But let me give you the exact example, right? Maybe that's not the same for everyone, but what in my family they would still remember is, so prior to that you would get a check to get paid. Either in cash or you get a check. You have to go to the bank branch at the 29th or 30th to collect the check and you get the money. So that's how you would use the bank, right? And so what those new generation banks would do, they would start to import the new technology that's called ATM. So, you instead of needing a check that you need to physically collect, you get a card and you go to the ATM and you collect the salary there. So that was just a new technology that they have adopted. The old guys, they didn't understand it. They didn't have the right leadership and mentorship to say, okay, we got to change, because there was still a bunch of clients that didn't mind to use the check that lived next to a bank branch, right? I think like in the end, what we're doing here is not that different.
Yeah.
We're just using a different way of decision making and another technology, which is like mobile first, no brands. And 20 years down the line, there's probably gonna still be some of the current guys that will make the switch. And then there will probably be 2 or 3 of us, none of us sitting here, maybe not even of us sitting here, maybe some other guy, but in the end, I'm confident 2 or 3 of like neobanks that are going to have some kind of scale.
Yeah.
I think Tosin's playing the ground game, right? I know you guys have gotten into point of sale as well. Lending money it's easy to give out money. It's hard to collect money. But, I think in terms of customer acquisition or a lending perspective, this sort of pure play neobank is interesting because I think that there's Neobank, right? Which is the darling, and right, if Kuda can be the new bank of Africa, that, wouldn't that be great? But then there's a number of banks that have struggled in Europe, for example, with profitability, and they've looked at subscription models and other things. And I heard you up on the stage talk about product diversification, for example. But how do you think about this question as it relates to your approach, knowing that you're moving in both directions, right? Like lending, distribution, from the middle.
Yeah, absolutely. So for me, I think the starting point is always the customer, and the customer wants many things. The customer wants credit. The customer wants lots of different products. A customer that's a retail customer potentially is also a business customer. So the way I think about it is the first point of call is, how do I own the customer? Not for anything in particular, but just how do I own the customer from the first point of call? Because the first point of call is that account.
Yeah.
So how do I become that account? Once I'm that account, then I can offer other things. So it becomes complementary. So I can do credit. And moreover, I kind of remember the first comment I made about sort of scaling credit, I need the deposit. The cash is my inventory. So I need to build the cheapest possible deposit taking entity to be able to even do credit. So if I'm really good at credit, but I don't have that inventory, it ups the stakes for me. And that's kind of how I approached it. It doesn't necessarily mean it's the correct way or the wrong way. It's just the way that worked at least for my thought process. I knew I had to also build trust. It's easier to sort of do credit once you have trust. I don't know how easy it is to find customers to come to you naturally as a sort of to deposit money.
Yeah.
I know it's certainly very difficult.
Yeah.
We had to do a lot of work convincing. So I just thought, let's put all our energy into building out that trust as an asset class.
Yeah.
And then, of course, collection is still a big deal for credit, but you know that there will be demand. You know people will come, once you figure out how to collect, which is the work that you've obviously spent, years.
Look, I think all of us have made the experience that, let's say I've made the experience, I don't know about you guys, I'm sure you've made the same. You're seeing someone else doing well or something works for someone else, and then you're thinking, okay, I got to do that same thing.
So you guys knew each other's business.
Of
very
course.
well.
Oh, yeah.
I'm sure, obviously I was very curious about what Kuda's doing, and then he was also curious about what I'm doing, then I wanted to know what he's doing. He wanted to know, okay, let me also do lending. It's the normal thing to do, and then we also look at who's doing what in Egypt, Kenya. In the end, the comparison set in Africa is small. My experience is very quickly, you're getting to a point that makes you appreciate the sophistication necessary in this business. Because if it would be easy, I always say this, if anything would be easier, I'll be doing it, and there would really be no opportunity, right? If it would be easy to run a merchant acquirer, and if it would be a gold mine, then everyone would be doing it, right? If it would be easy to give loans, then everyone would be doing it. If it would be easy to mobilize lots of deposit, and we're doing it,
Yeah.
So very quickly we realize, okay, this is actually hard, and then you fail, and then
you get it.
and then you get it. No, you fail again, and then you do a bit better. And there's a reason why we're doing this for 6 years. This man is doing it for 8, 9. This, when you're doing something, it's not that we're sitting there and do nothing, right?
Yeah.
Learn.
And how does that affect product diversification decisions that you make, and also expansion, right? Because I think it's hard enough to diversify product in one market, right? I think there's a question about Nigeria is a big country. It's pretty deep. I know that, to various degrees, you guys have been looking outside of different markets, thinking about trying to go deeper into, servicing a customer, building out what you're doing, different products in Nigeria versus then going abroad.
Look, everyone has thought about it, and I think my opinion is there's only wrong decisions, because you're dealing with a currency that you can predict and that's doing really poorly, right? So any decision I think that you would have taken, pretentious to talk about in hindsight as the right or wrong thing to do, because we focused a lot in Nigeria, and I was really, I didn't want to think a lot about expansion just because it's hard and we don't get it, and people speak a different language, and then they do business differently, and then you try to acquire them, and then the bank, and it's hard.
So I think ultimately it's a bandwidth question. So Naomi, you know what they say about focus. Execution is really hard. You need escape velocity to launch a product. And as a startup, you are starting up, you have minimal resources. And these resources needs to be devoted such that anything you focus on needs to reach its escape velocity. So it's a bandwidth question. And this is the fundamental reason why you need to focus. But usually what now happens is that when you mature a product, the bandwidth required to continue running that product reduces, because it's matured, it's now an adult. It can take care of itself. You've gotten burnt, you've done everything, then you can focus on the next things to do. But the way to look at it, however, is a bandwidth, right? Because if you look at organizations like Amazon, Microsoft, Google, they launch products, shitload of products. Some fail, some succeed. They have large organizations, plenty of verticals. So this is not a question of why organizations cannot actually succeed at having multiple verticals. It's a question of bandwidth. This bandwidth is about, one, your execution maturity in terms of processes, systems, two, investments you can make in terms of, capital into the product itself, as well as every other factors of execution or production that you need. So in essence, as a startup, where you're still battling with maturity of your core product and you have limited resources, to get escape velocity, you should focus on a few products. As you begin to grow and you have more resources and you've matured and you know how to do things, business as usual, then you can actually work on more products. Now, these more products can now be more products, different geographies, different products in different geographies. So I think that's the way to look at it.
I agree, on the bandwidth issue, but I think being a highly regulated entity adds a different level of complexity.
Yeah.
Because, the regulation are different in different countries.
Which complicates the bandwidth requirements. So that's essentially, because bandwidth is a complexity solving thing. Execution is about fixing complexities. So because you now have multiple regulations in different jurisdictions, adds more layers of complexity. But assuming you've done it before, business as usual, you know the FCA, you know what they are looking for. You can do it again and again and again. It's not a big deal to you. Then you can easily expand. So the real limitation that you have is bandwidth. And different organizations have different bandwidth. There are organizations that just manage to get to where they are. There are organizations that are really, really matured. If an Amazon said that they are coming to do my business in Nigeria and they devoted their bandwidth in Nigeria, I will be afraid.
I disagree with
No.
I mean, you should be worried.
No.
But I think you have something
Like I said,
that they don't.
Like I said, they devoted their bandwidth to it. Because at the top, there are few important things. But because the bandwidth is so large, there are multiple things they're working on. At different places, the focus is different. It's small because it's kind of diverse.
Amazon would deal with CBN.
They will find someone.
That's what I said exactly.
But I think one thing I want to overlay.
Or they acquire. It's all about bandwidth.
Yeah.
Exactly. So it's all about resources. That is the point about resource thing. We convert sweat equity eventually to capital. That's what we do. That's what the entrepreneurs do. But they have done it. They have shitload of capital. They don't, to execute it, they don't even need to do it. They just simply acquire.
But there's a lot of examples of companies coming to Nigeria from South Africa, for example, and not finding.
And they fail.
And there are also tons of that also succeeded.
Yeah, that's true.
Yeah.
There's both.
Yeah. So like I said, it's simply a bandwidth thing. Nigeria is complex, that's the point. Between regulation, markets, people, the resources required to execute it. But do you have the resources in terms of people, knowledge, processes, systems to be able to execute it? That's what's required. So if I want to expand to Kenya now, I am a little bit afraid. Like, Kenya is a matured market with the same level of complexities, regulation, capable competition, the bandwidth requirement to really succeed at that. Even if I took away all my things from Nigeria and focused on just Kenya, would I still have succeeded? So I think ultimately that's just the way to look at it. So that's the framework that can connect small startups expansion to big startups expansion. It's just a bandwidth.
Yeah, but you want to...
I want to just add one thing, because I think what Tosin is saying is an interesting way to look at it, but I think there's another complexity that we haven't talked about, and that's the point I tried to make on currency. Right? Because in the end, if you expand, in the end here, it's like a resource allocation question. And what you're really looking for is, I'm making this investment decision of time, he calls it bandwidth resourcing, right? My team's time or money. And I'm expecting a certain ROI on it, right? And so why I say
resources,
so I want an ROI. I want to either generate more revenue or get something for the story or whatever the driver is. Right? Yeah, there's different drivers. And especially we talk about expansion, a lot of expansion is done to be able to say, but the point I want to make is, so why it's hard to take the right decision in Nigeria when it's about expansion is that, the fundamental input on output of resource is how much time do I invest and what do I get back. But if your currency is heavily unstable, you are actually it's hard to predict that output. Because you could spend a lot of time and the Naira is doing well and the product is proceeding in the business plan as you have projected it. So let's say we start a point of sale machine device business, or Tosin has tons of good people for lending, but because the currency is shrinking by 300%, your real dollar ROI is really negative or low. That same applies when you expand. You could also say, I want to expand the product. You spend all of your resources on it. You go to Uganda or Kenya, but the product is doing okay, but your home currency is actually shrinking, so the product is actually doing extraordinary without. So you need to think about that as well.
Yeah.
And one other thing also, when we talk about expansion, you also have to think about none of the products that we are running are the same and are also completely translatable into other markets. So you can't do big scale agency banking business or US business in Kenya, right? Lending looks completely different in Kenya too. So the expansion story in Africa is a complicated one because the users are different, the regulatory landscape is different, everything is different.
Yeah.
This episode of The Flip is sponsored by Own a Freak. The lending business model should be simple. Disperse loans and collect repayments. But when it involves bulk payouts or loan collections in multiple currencies, it's still simple because Own a Freak's real-time bulk payment service is built to simplify your lending business. Their plug-and-play solution, designed to streamline your processes, helps you to manage loan repayment reconciliations effortlessly, receive a settlement in a currency of your choice, and reduce the costs associated with bulk payments. As an omni-channel payments network, their connections make it possible to offer your customers to an extensive range of payment options. With over 500 million mobile wallets, 200 million bank accounts across 40 African countries, and convenient cash pickup options in Nigeria, you can efficiently disperse loans and receive payments. Ready to scale your lending business? Visit ownafreak.com to learn more.
So in the context of all of that stuff that you just talked about, I think in particular the expansion challenges and, the Naira challenges, like we're here in New York right now at a FinTech in Africa conference with a bunch of global investors. You guys have raised a lot of money from non-African VCs, from global VCs who are expecting dollar-denominated returns. So I guess I'm curious to get your perspectives on, how are you thinking about growth? What is the story that you're telling to, the global investing community about your businesses, about the region, about Nigeria? And are there any, I suppose, lessons or points of hope or anything that are particularly important to share about?
Yeah, sure. I think fundamentally, you can't necessarily control a macro. I think the question you have to ask is, if I build a business, if I build a bank, and it's, say, the top 3 bank in Nigeria, whatever the currency says, it's going to be worth a lot of money. So I think you just have to look at it, not just the short term, but also sort of mid to long term. Because honestly, as we've talked about, expansion is complex. You want to diversify risk, currency risk, that might land you in hot water. But you just need to focus on the fundamentals of the business. Are your customers growing? Is your revenue in local currency growing? And are you becoming a big player in your market? And, you look at Nigeria, history of Nigeria, we have always had currency devaluation. I remember when, dollar was 120, I remember when it went to 150, it was crazy. I thought, oh my God, but back then, we still had big banks and they were still worth a lot of money. Today, currency is 700, not today, but it's gone up to 450, 700, 1,500. The big banks are still big banks and they're still extremely valuable. So I think the whole currency thing is more around, timing. You can become super successful today, or actually, if you're unlucky, like we kind of have been in this moment in time, it just elongates the time to choose success. But I think if you have fundamentally a good business, I think it's still a great story.
Yeah. Tosin, what do you think?
Yeah. I think, following on what Babs just said, fundamentally, investors are interested in returns. I'm like, if there's anything that's less sentimental, is finance. I don't give a fuck about. Just
we'll edit that part, right?
Give me my returns. And when people are judging returns, they are looking at pure growth. They are looking at the risks that also come with those growth. And different of investors at different stages have different risk appetites and different growth expectations to back it up. And I think ultimately exits are generally expected to be in the profile of no risk, moderate returns. Global. And that's where the Nigeria come in, because first, the macros of Nigeria in terms of currency valuation adds more risk, but there's also more risk in addition to the actual macro risk. And it's the risk of opacity. And that's why this conference is good.
Yeah.
You are generally risk averse to something that you don't know. And the markets that are actually the most liquid, the US markets, actually don't have a lot of knowledge about Nigeria or Africa. And this increases your perceived risk in addition to macros. That is why the investors that will eventually invest in you investors that understand it. And those investors have a way, they already manage the risk, they price the risk, they're comfortable with the risk. IFC is still investing.
Yeah.
Propaco is still investing. Africa Focus Ps are still investing. So essentially, if you look at it on that fundamental basis, it means that if you want to go to certain markets like the US, especially in the stable of times, you are going to be, either they are not interested because there are better returns on investments with less risk, or maybe you get bad pricing. Most likely they'll just say no because of the risk. So that's the way to look at it. That's why I'm not blaming the investors. So if I wanted to do anything in the future, I will try to find ways in which, looking at the kind of markets I want to exit, how can I improve my profile to them, which means, of course, do all the good things, have a good bottom line, be growing rapidly, improve the risk perception, which is why all of us are trying to, most of us, I believe, are trying to diversify. And diversification at that stage can't just even be on an optical level. It has to be on a real level, on the basis of revenue that's coming in terms of share.
Yeah.
So I think that's simply the way to look at the reality of African markets. Now, a solution to it is for Africa itself to develop such that the stock markets or the public markets in the countries themselves actually become really viable, really liquid. They are going to be the best supporters. If Nigerian stock markets actually begin to give good multiples to fintechs and Nigeria becomes quite liquid, I think this will actually encourage foreign investors themselves to actually price us the way it is. But for now, these are factors we can't produce. You just need to handle your business in a way as if the worst case scenario is dividends.
Maybe two things there. So first, I agree with Tosin. I think it doesn't get less sentimental than finance, right? And the reason why our investors or all of the guys that are here invest is to make money more, right? That's their essential task. The money that is still investing in Africa now is oftentimes money that actually has a different job. Not necessarily make money more, but IFCs invest in Propaco's investing, all of these names are investing, but most of their LPs are actually not return-driven investors. They have a different job. They make the money, not less.
Yeah.
And
develop
the country, right? So, if you ask me like how I generally feel about venture returns in Africa, I think the returns can be there, but you need people with a different job description, because only those can have a realistic timeline, right? We didn't talk about time, right? Return is a question of percentage of increase over a period of time. So what happens if the currency devalues, for example, is that you're losing time. Essentially, it's making the whole thing you did in 4 years, making it 6 years, because you need another 2 years, right? So the kind of investors I think that are going to look at Africa now and learn from it and are going to continue investing are still going to be investors that have a slightly different visibility and view on what is the risk I'm happy to take and what job am I needing to do. And I really hope, right, that this investor pool can grow, right, so that we don't only have the DFIs and DFI backed, right? You have DFIs and then you have DFI backed, the Helios and whatever the name is. And then in the best case scenario, as Tosin says, is to develop like a playfield that actually does like decently okay. Like let's say LATAM style. It doesn't need to be the US, but LATAM style, where if the currency does badly, it performs 15% under expectation, not 300. And then you get people that are high risk, high return seekers. And I hope we will in 10, 15 years sit here and have just a bigger investor pool.
Yeah. I think it's happening. I'm making that bet as well. So, right, that people will start to look at this market more as they do Latin America or India or China. As my last final question for each of you, as I was hearing you guys speak, I thought it was quite interesting to think about like comparing banks, right? And we look in the startup ecosystem a lot and we say that, these guys are all doing the same thing, right? And why is everyone building the same thing? Even though you guys are all doing it from a different perspective, when you think about banks, there's enough room in the market for, how many banks are in Nigeria? 10 banks, right? And so I guess with that in mind, I'm curious to think about what you guys each think success looks like for your respective companies, and then how that informs, I guess, like what the market looks like in Nigeria and across the continent from a competitive perspective, over the next 5, 10, 15 years, whatever time horizon you're thinking about. for how you're building and what success looks like. You want to go first, Babs?
Sure. The good thing about banking specifically is it's never a winner takes all. I think the risks are just too high for a regulator to allow one single dominant player, just because, they have to look after depositors' funds. If you look at all the markets, like banking generally, there's usually at least 3 key players. Sometimes it will be 5 or 6. Even take Nigeria. We have 25 or so banks, but essentially we have, I would say, 5 big banks that control, I would say, 70% of the deposit base. And it's like that everywhere else. Even in the UK, you have HSBC, NatWest, a couple Lloyds, and then you have the others. Same in America. So I think I'm happy that there are strong players in the digital banking space, because it makes it acceptable, it makes it mainstream, it makes it legitimate, it brings credibility to it. There shouldn't be too many, but
Just you 3. That's enough.
and I think very quickly we're already seeing like who is shaped to kind of be the players. So yeah, from a competitive landscape, because we're still kind of maturing, we can only hope that the key players, the important players, the systematically important players actually succeed. So even though, Tosin and Laurin, I see them as competition, but I actually also need them not to fail, because it kind of brings the whole house down if we haven't even really launched properly and they're already failing. So the smaller guys,
I need them to be alive.
just
Be alive.
be alive. That's what I said. I didn't say I need them to succeed. I said I need them not to fail.
You can be around.
Yeah, but it's true. It just puts more pressure on the whole credibility of digital banking, because that's really what we're trying to do here. We want it to be mainstream. Once it's mainstream, it's actually relatively easy to acquire customers, because naturally people need financial services. They will come to one of us. So yeah, and that's how I see, competition in the space.
Yep.
Okay, yeah. On exits, so what does success look like? I mean, being venture backed, there's an expectation of giving a return, and I think a lot of our investors have like a fund life, which implies at a certain time they have an expectation that you return their money in bulk. So I think part of the success metric will mean generating some form of exits. Success metric also will include getting the company to a level of maturity that you don't need to be donating a pint of your blood every week to get it running. Success metric, and that means some level of maturity in terms of product, compliance, processes, finance. I have impact goals. I think most of us have impact goals. Success will also mean reaching our impact objectives in terms of lives touched for businesses and for consumers across geographies. So for us, it's in the next couple of years, be able to return some money, meeting at least the ROI objectives, exceeding the expectations to our investors, shareholders, employees that have also devoted a lot of their life into the product, into the company. And then secondly, we now be also, maybe somebody else is attending and doing the flip, and I can rest somewhere. I don't know if that's a pipe dream, but it's obviously going to be, I need to be able to spend more time with my daughter, my son, but right now, it's just hard,
Wow.
So I think for those things, those are the key metrics for success for me.
I think on the what success, let's start with the competition one, right? So, my thought on competition is I get to think about it more and more. Depending on which product you have, you will always have competition. And then, the interesting thing is because Africa is in the later end of venture building. So most of the models that we built, take merchant acquiring, already are matured in many other markets. So sure, Tosin shares that, but if you talk to a venture investor about merchant acquiring, the first reaction would be, you have to look at your margin because eventually it's going to be competed away, and you have to do other services, right? So they see that they have this muscle memory. So I got to think about competition really as whatever you do, you are going to have competition. And these are like market dynamics that are never going to change. There's always people that are hungry for growth. You are never going to be the smartest guy in the room. And if you're lucky, you're going to be part of the 20% that makes 80% of the volume, the revenue, the gross profit has 80% of the customers. So in that sense, I look at competition just as a forcing function to always do the best job, and it rewards you if you are, and it punishes you if you are not. That's my thought on competition. I mean, generally within FairMoney, we tried not to overthink and overspend time on competition. We use competition as a benchmark, but we don't use it to inform what we do, and definitely we never use it to inform how we do it. I think that's something we're very particular about. Then on returns, look, on how does success look like? I tend to agree with what Tosin is saying. I mean, for me, there's 3 different ways. The first one is people gave us money, and we claimed to be able to make a venture story in Africa work, right? That is the claim that we did, I did, and many others did. And I think it's going to be, and I don't know, this is laughing, but my thinking is, it's going to be very hard for all of us, lots of work, to prove that this actually can happen.
Yeah.
Some people are going to try to do an IPO here, another way. There's a lot of pressure, and we have to deliver. And I think my first and foremost responsibility is I want to give people that trusted me 6 years ago to build a business in Nigeria, and everyone told us you're crazy, and everyone told them you're crazy. I want to make sure they are very wealthy based on that decision. And then I also want to make my employees wealthy, because these are guys that I have those, you have them. They are working with me for sometimes 6-7 years, right? And they do that because I have a talent that is motivating people for something I believe is the right thing to do.
Yeah.
So let me prove that actually was the right decision, right? That is the number, that's the tool most important. If we achieve any of that, and the scale of that, the scale of that can differ, right? It will be very difficult for me to provide someone that invested in Neobank 5 years ago with that same return. That is not the bar. It can be the bar, but maybe it's 50% of that. That would already be a success.
Yeah. Do you just want to talk about what success looks like for Kuda, and then we can leave it there?
Yeah, of course. I mean, I definitely agree with Laurin and Tosin. Return to your stakeholders, your investors. I see my employees as also my investors, because they're investing their time essentially to the vision, to the dream. So yeah, it's a big challenge. Sometimes it feels like you're swimming against the tide a lot of the times. But I also believe that, even when you're swimming against the tide, if you don't give up, if you keep swimming, you will get to the other end, But to your point, it's going to take you longer to get there, But of course, if you're swimming with the tide, it's just easy. Everything is, there's that momentum. But the swim has to be made.
Yeah.
We just need not to drown in the middle of it. And we will get to the other side. I'm confident of that.
Too much agreement amongst you guys in this conversation. No, I understand. But I appreciate all of you guys taking the time. I really do. We should leave it there, yeah?
Cool.
So,
absolutely.
Thanks so much. I appreciate it.
Thank you. Perfect. Thank you.